The Stanlib Africa proposition was launched 4 years ago. Its objective to seek out African companies with the highest upside to fair value. The fund concentrates on companies on the continent, excluding South Africa. The fund has beaten its benchmark over the last 3 years, but the going has been tough. Humphrey Gathungu, portfolio manager at Stanlib, joins us on the desk to discuss where companies like Orascom Construction and Guaranty Trust Bank fit into the portfolio. Welcome, Humphrey. Good to have you here. I'm going to start by asking you, just looking at the description of the fund, it's categorized as a very high risk. So already there's a health warning. Is this because it's an Africa fund? Is it because it's typically a fairly illiquid market?
Yes, Africa is a frontier market, so you'll have that it's a high growth area but also very high risk area. You have regulations are not as perfect as the rest of the emerging markets. You find companies are still young. You find that the cost of doing business tends to be much higher, and hence the business cycle then tends to be much longer. So we warn our clients that this is a high growth opportunity, but as well as a high risk one. And if you see the returns over the last couple of years, will attest to that. You'll see, like for instance, last year you had Egypt going down about 49%, but this year it's up about 60%. So it tells you the sort of return that you'll have, and it's very highly geared as a market.
Humphrey, your mandate gives you a fairly free rein. So the theme is African, but no particular topics or industries that you invest in.
That's right. We try to keep it as unconstrained as possible. We are style agnostic, and we try to construct our portfolio bottom up. So we essentially do a lot of work, a lot of our own proprietary work to try and ascertain what are the different opportunities and themes that we like and are attractive, and we then try and invest in those, and we try to offer our clients those opportunities in Africa.
Humphrey, just in terms of the universe for viewers watching the show tonight, you've got the ability to invest anywhere on the continent except for South Africa.
That's right. In
terms of the number of stocks and the market capitalization, perhaps in US dollars, I suppose that's the best way of judging it. How many stocks are there for you to look at and research on the continent at the moment?
Well, if you look at the continent, the stocks are quite a number. There'll be in excess of 1,000 stocks that qualify for a universe. And also it's important to mention that we can also look at stocks that are listed outside of Africa but have a majority of the business or net assets coming from Africa. What we then do is that we then employ our own proprietary filters at Stanlib to try and focus our attention to where we think the value is and where you think the liquidity is. So we filter out the very small and illiquid names, and we end up with a universe of about 200, 250 stocks. These will then tend to be concentrated mainly in North Africa. Mainly Egypt is your largest market, followed by Nigeria, followed by maybe Kenya in that particular order. You'll find that Morocco is also a big market, but sometimes you may have some challenges in liquidity outside maybe the top 5 stocks that are in that particular market. So that gives you a sense of the size of the market and sort of the depth of the market. Okay.
In terms of some of the companies that you say are listed elsewhere but that are operating on the continent, can you color for our perspective what some of those companies are that are building substantial businesses on the continent?
Yes, we've come across some exciting opportunities. You'll find that some countries may have some interesting stories to tell, but they do not have a listed a stock exchange, for instance, say for instance the DRC or Mali, for instance. So to give an example, a company like Rand Gold Resources is a gold company in Mali with very attractive reserves, very good cash cost, and very well run management. Since Mali there's no stock exchange, you'll find that it is listed in London. The other advantage that these companies have is that they're listed in fairly developed pools of capital. So, you know, London, Australia, and Canada, you have an investor base that has a long history of investing in very young, exploring, and developing companies, and that's what you find, that they're able to raise money a lot more quicker there. So we have the advantage of being able to invest in such good stories, good emerging stories.
Now, many of the audience might be familiar with the pools of capital, specifically with reference to some of the resource counters and the resource markets that you've indicated now. Are there companies from other sectors that are investing aggressively on the continent?
Certainly. We've come across certain agricultural plays that are listed outside of Africa. For instance, there's an emerging palm oil sector in London, which we like. We think palm oil is an interesting play on the emerging consumer theme in Africa, and certainly you find them that they've been listed in London. Agriculture tends to share a lot of same characteristics like resources, in the sense that you have a huge undeveloped resource that requires huge amounts of capital and expertise to develop. So again, you find that this requires, you know, a specialized pool of capital that is deep and long and patient enough to invest in such opportunities.
You talk about patience. How patient do you need to be in this fund, and how patient does the typical investor need to be in this fund?
Like I mentioned earlier, the business cycle tends to be a lot longer in Africa. Just to give an example, when you speak to some of the plants setting up in Africa, say some of the breweries and the like, they'll tell you that the cost of setting up a plant per hectoliter is much higher in Africa because they have to invest in a lot of, health, sanitation, and infrastructure, to tie up to that plant. So that rises the investment cost somewhat, but you'll find that the returns also are higher given that you're able to sell, your products at a much higher price. So margins are also as well higher. So with that in mind, we think that the return period should be at least much longer than you would have in the rest of the world. I would estimate certainly longer than 5 years. I think is a good period to be able to see, your investment through the cycle and see some of the themes actually coming into fruition.
In terms of some of the counters in your portfolio at the moment, I'm looking at a fact sheet that says that Orascom Construction is one of the biggest holdings. Just to get colour for us, what exactly does Orascom do? Obviously construction, but whereabouts does it operate, and why is it attractive to you?
We like Orascom Construction because it's a best-in-class construction company. If you compare it even to some of the South African peers here, you'll find that the margins are a lot higher because they're able to integrate quite a lot across the entire value chain, right from the beginning to the end. And the other thing we like about it is that they are specialized in infrastructure work. So they build, power stations, things like airports and sort of like desalination plants across the Middle East and in Sub-Saharan Africa as well. The other interesting thing that we like about Orascom Construction is the fact that it also has exposure to the fertilizer industry, and particularly in the nitrogen fertilizer industry, which we also like, that plays on the low cost of gas that you have in the Middle East. And this is a very high margin business. We've seen them report margins of as high as 75% in the fertilizer business, and margins as high as 13% in the construction business, which is very, very high compared to their peers even in South Africa. Yeah.
There seems to be we look at the continent and we see sort of pockets of regional blocks where economic activity is booming. What's the difference between the culture in terms of the way business is done in a place like North Africa versus a place like East Africa, and how easy is it for you to analyze and compare companies in both those areas? You're
certainly right. Africa is certainly very different. There's a lot of diversity in the continent, and we think that's actually an opportunity rather than a weakness. And we find that across Africa, a lot of the companies actually complying with IFRS. A lot of them have an emerging investor community, investor relations, so you're able to get a lot of information that you need. But one key difference we find is that it's a relationship-driven sort of approach to meeting with companies and investing with these companies. So over time, we've developed very, very deep and strong relationships with the company management to be able to, pick the phone and call them and get info that you need. And we find that tends to cut across the continent, both North, East and West Africa. Certainly you find that when management come to know you, they'll trust you with information. They'll be able to help you along with the investment thesis and also tell you when things are going right and when things are a bit challenging. But certainly there are differences within the regions. You'll find that, for instance, East Africa as a region is a lot more integrated than you'll perhaps find the North and the West. You'll find that as an example, Kenya, exports out of Kenya, about 30% of that export goes actually into the surrounding region, and that's why we like the East African region in Kenya in particular as a play on the wider East African region. And when you have that regional integration in Kenya, you're talking of addressing a market that is in excess of 120 million people, which is almost the size of Nigeria's 180, 160 million people, or Egypt's 80 million people. So you find that with that integration and with that linkages within that economy, you find it easy to move across the region.
If you compare with your index, perhaps you could just tell us more about the benchmark that you use and why you chose that particular benchmark and what the options are for someone in your position. But what are the big bets that you are taking relative to that benchmark?
Certainly. The benchmark is Nedbank 100 X South Africa. We like it because we think it's a lot more balanced than some of the alternatives that we've seen out there. It certainly takes into account liquidity, which is a very, very key. Like I mentioned, there are 1,000 stocks or more on the continent, but really when you filter for liquidity, number comes down to about 200. So you'll find that a lot of stocks actually don't trade or were listed maybe for tax purposes or other purposes, maybe to gain recognition and to be seen as a local company. So you've got to, filter out all this. So we like that benchmark because we think it takes into account, one, liquidity, two, it tries to avoid sector concentrations. You'll find that in the continent, a lot of the stocks tend actually to be banks in the financial services. So if you just follow a benchmark, you'll then end up having a very, very high concentration in banks, which we also want to avoid, because we think Africa's story is much wider than banks. There's an emerging consumer story, there's a construction story that's coming up. So banks certainly good, give you an access into some of these sectors, but certainly it's not the whole story of Africa. So for those reasons, we selected that particular benchmark. And at the time when we launched the fund, the options were actually very limited. It was some funds were actually looking at LIBOR plus as a benchmark, and we didn't think that was a credible benchmark to use, and certainly not then tell our clients much whether you've performed well or not.